Ladies and gentlemen, good day and welcome to the Anupam Rasayan India Limited Q2 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Thakur from EY. Thank you, and over to you, sir.
Hi, thank you, Inba. Hello and good evening, everyone. I'm pleased to welcome you all to Anupam Rasayan's earnings call to discuss Q2 FY23 results. Please note, a copy of all our disclosures are available on the investor section of our website as well as on the stock exchanges. Anything said on this call which reflects our outlook for the future or which could be construed as a forward-looking statement must be reviewed in conjunction with the risks that the company faces. Today, from the management side, we have with us Dr. Kiran Patel, Chairman, Mr. Anand Desai, Managing Director, Mr. Amit Khurana, CFO, and Mr. Vishal Thakkar, Deputy CFO. I now hand over the call to Dr. Kiran Patel for his opening remarks. Over to you, sir.
Thank you, Rahul. Thank you all, and welcome to everyone to the Q2 FY23 earnings call. I hope you all enjoyed the Deepavali festivities. The last 24 months, the world had faced unprecedented human toll and economic challenges. Just as the world found a solution to beat COVID, the Russia-Ukraine conflict created a second major economic crisis. Crude oil prices skyrocketed, shortage of gas supply to Europe leading to energy crisis in Europe, inflation in the crude-derived chemical price. These major trends led to several subtrends: higher transportation costs, high inflation across the globe, higher interest rates, higher cost of the raw material, disruption of supply chain. Additionally, an important subtrend for many global companies is the Europe Plus One strategy and its impact for India. I will let Anand elaborate on how this has affected Anupam Rasayan. Friends, a true test for any company and its leadership is how they handle both local and global challenges. At Anupam, the first challenge of COVID was handled very well. Majority of all our staff members were vaccinated. During the COVID period, there was uninterrupted production of all chemical materials, meeting all our customer needs. Anupam posted a robust growth and met all of the projections and the projected numbers in spite of the COVID challenge. Now, let us focus on Q2 FY23. I'm happy and proud to say Anupam Rasayan has continued its robust growth journey and, more importantly, has also maintained the profit margins. The natural question would be, how did Anupam maintain both growth and margins in spite of the overwhelming odds? The answer is that Anupam Rasayan always works with a long-term view. The robust R&D department allows us to develop niche products with complex chemistry, and this ensures that we are strategically placed with our partners and customers. Most often, Anupam enjoys the open, transparent model. Many a times, Anupam is the primary or single supplier. This strategy has resulted in Anupam having 27 multinational customers. A good example is that we have no business with multinationals in Japan, Japanese or a Japanese customer in 2016, but today we work on 4 products for them. The transparent cost-plus model and along with that high quality complex molecules results in robust long-term relationship with our customers. My apologies. Our focus on sustainability continues to remain strong. We have engaged the services of major international service providers, and we are working very closely with them for designing and implementing the decarbonization roadmap across all sites. I am pleased to announce that our 5.4 megawatt solar power plant got commissioned in October 2022. We now have a total of 17.9 megawatt capacity, resulting in annual savings of around Indian rupees 14 crores from FY24 onwards. Our voluntary effort of planting trees on the 20,000 square meters of barren land in Jagadia GIDC is going on as per our plan. The safety and well-being of our employees is the highest priority for all of us at Anupam Rasayan. I express my gratitude and support to all of our employees and especially those who were affected by the fire accident at our Rasayan plant. Steps to ensure the safety of all are being taken, and to those who were affected, we have taken actions to ensure lifelong support to their families. I will let Anand discuss this in greater detail. I would now hand over the floor to Mr. Anand Desai, our Managing Director, to take over the proceedings and address you all. Anand.
Thank you, Dr. Patel. Hello and good evening to everyone. Welcome to our second quarter FY23 earnings call. Hope all of you had a safe and happy Diwali with your families. Before I throw light on the business performance and updates for the quarter, I would like to discuss the fire incident at our plant. On 10 September, a fire broke out in one out of the 4 units in unit number 6 in Sachin GIDC. Our fire response team, along with fire brigade, brought the fire under control within an hour. While the cause of fire is still in the investigation, it was a clear accident. A total of 6 fatalities were reported, and 18 employees who were injured have now been discharged. From the business perspective, I would like to highlight that Unit 6 in Sachin GIDC has the lowest capacity of all the 6 manufacturing units in the company, and we are covered for loss of assets and loss of profits. Given all our facilities are multi-purpose units, we do not see any significant impact of the fire and plant closures on our financials. We have appointed a high-level team to undertake a root cause analysis. Learning from this analysis will help us in avoiding such accidents in the future. That said, we are continuing our cooperation with all the government authorities. I am confident that we will soon restart the affected plant. As Dr. Patel mentioned, we continue to deliver a strong revenue growth with steady margins against a very uncertain economic backdrop. Our standalone revenues grew by 25% year-on-year to rupees 310 crores. EBITDA margins were consistent, driven by inventory holding strategy. I will let Vishal Bhai discuss this more in detail. I would now like to highlight our working philosophy of carrying a long-term vision that Dr. Patel alluded to in his opening remarks. Our vision is to be a globally reputed chemical manufacturing company with respect to our research, technology, quality, safety, and care of our environment. One of the main pillars of this vision is the client centricity. Dr. Patel gave you examples of how we brought a new Japanese client on board and with our formidable client relations.
Sorry to interrupt. Mr. Desai, may we request you to hold the handset a little closer to you because your audio is sounding a bit muffled, sir.
Sure.
Thank you.
Dr. Patel gave you examples of how we brought a new Japanese client on board, and with our formidable client relations, we expanded the relationship to build a solid product portfolio. This has been possible because of our continued efforts on process optimization and expanding chemistry capabilities. Our experience of working with multinational clients for more than 2 decades and our transparent cross-trust model has helped us build a trusted long-term partnership with all our clients. Let me now discuss how this is helping us in what is being termed now as Europe Plus One strategy going forward. Our long-standing relations with the clients have made Anupam a go-to company for any challenge they face. In Europe, as many of you know, the energy crisis has created a challenging environment, making it difficult to manufacture products at a reasonable cost. This has led to several multinational companies seeking to shift a part of the sourcing requirements from Europe to India. Along with China Plus One trend, Anupam has now started seeing the benefits of this Europe Plus One trend. With our latest announcement of signing 2 contracts with one of the major European crop protection company for supplying of 2 new life science related specialty chemicals, and in this we were able to deliver these products in a short period on the urgent request of our customer. These contract wins are a testament to our chemistry strength, our ability to deliver products based on the requirement of customers. Moreover, both these products were being manufactured in Europe, and now the customer has decided to source these products exclusively from Anupam going forward. We are working with few more MNC clients, both in Europe as well as in the US, and expect 20 to 25 niche products to be added in Anupam's product portfolio in the near term as part of Europe Plus One strategy. This has been in the works since last 1.5 to 2 years, but with the Europe Plus One situation, this has got an added urgency from the customer side now. Coming to the business updates, we have successfully onboarded one of the largest specialty chemical companies based out of North America, and with this addition, we now have 27 multinational customers across the globe. During the quarter, we also commercialized one new product, taking the total products tally to 49. This new product commercialized comes under the LOIs and contracts that we signed in FY2022. Soon we will commercialize other products as well under the LOIs and contracts. As mentioned in the previous earnings call, we continue to see strong demand from our clients. Another positive impact of building a trusted partnership with clients is that we continue to see upward bias in all the contracted volumes with major customers. This makes us confident about delivering a strong performance in the coming quarters and for the years. Before I conclude, I would like to speak about another important highlight of the quarter. I am delighted to inform you that we have completed a fundraising of this 500 crores to qualified institutional placement. The response to our QIP was very positive, and we now have long-term marquee investors along with our earlier marquee investors. The proceeds of this fundraise will accelerate our capex plan of rupees 670 crores approximate to set up multiple plants both in Sachin and Jagadia. I will let our CFO Amit Khurana discuss this in detail. Over to you, Amit.
Thank you, sir. Good evening, everyone. As Anand sir mentioned, we have completed a fundraise of rupees 500 crores, and the funds will be deployed in carrying out brownfield expansions at Sachin and Jagadia locations. I will now provide more insight into the planned capex. In our previous earnings call, I had highlighted capex of rupees 250 crores to support the LOIs and contracts signed worth rupees 2,620 crores. Now, along with this capex, we have accelerated our capex for chlorination products, which is of rupees 420 crores. This will be divided into two projects, with project 1 at Sachin is for rupees 190 crores and project 2 at Jagadia is for rupees 230 crores. Given all the capex projects mentioned above are brownfield in nature, it is important to understand that it will be majorly a plant and machinery capex with an incremental asset term of over 1.75x. This will also give us an incremental ROC of 20% plus. Our endeavor would be to finish this capex in the coming 18 to 24 months. It is also important to note that we have a cash balance of rupees 192 crores, which will be sufficient to support the incremental fund requirement over the fundraise for the overall capex. As mentioned in the earlier calls, we have now started seeing reduction in the inventory days. Our inventory days have reduced from 296 days to 273 days. This is the result of the proactive steps taken by our team by revising the pricing mechanism clause in contracts to 6 months and reduction of cautionary inventory. Further, this has led to healthy OCF of rupees 97 crores for H1 FY23, which is higher than PAT for the period. We will continue to see the increase in operating cash flows, which will further improve the return ratios. These cash flows, along with our current cash on balance sheet, will ensure any further capital requirements for fulfillment of growth opportunities. I would also like to highlight that India Ratings has assigned a long-term issuer rating of A+ to Anupam Rasayan. With this, I hand over the floor to our Deputy CFO Vishal Bhai, who will take you through the financials.
Thank you, Amit Bhai. Hello, everyone, and thank you for joining us here today. I would like to briefly touch upon the key performance highlights for the quarter ended 30th September 2022, and then we'll open the floor for questions and answers. Before I proceed, I would urge you to go through the detailed presentation submitted to the stock exchange and uploaded on our website. Kindly note our numbers for the quarter and half year on a consolidated basis also include 10 fact numbers, which have been consolidated from 21st May 2022. I'll first discuss the standalone financial highlights for the quarter ended September 30th, 2022. Operating revenue for the quarter two FY23 was at 3,107 million rupees as compared to 2,489 million rupees in Q2 FY22, up 25% YOY. EBITDA, including other revenues, was at 898 million rupees in Q2 FY23 as compared to rupees 697 million rupees in Q2 FY22, a growth of 29% YOY. This would also translate to a 29% EBITDA margin for the quarter. Profit after tax was at 412 million rupees in Q2 FY23 as compared to 358 million rupees in Q2 FY22, growth of 15% YOY. On a consolidated basis, operating revenue for Q2 FY23 was at 3,862 million rupees as compared to 2,489 million rupees in Q2 FY22, up 55%. EBITDA, including other revenues, was at 1,012 million rupees in Q2 FY23 as compared to 702 million rupees in Q2 FY22, a growth of 44% YOY. Profit after tax was at 478 million in Q2 FY23 as compared to 361 million in Q2 FY22, growth of 33% YOY. Please note consolidated numbers for Q2 FY22 do not include Tenpac Industries number, so please read accordingly. Now, moving on to the segment-wise performance for the Q2 FY23, our life science segment contributed around 277 crore rupees, while other specialty chemical contributed around 32 crore rupees. In percentage terms, the life science segment contributed 90% of the total revenue, and the balance came from other specialty chemicals. As far as revenue breakup is concerned in terms of geography, Q2 FY23, the contribution of Europe was 35%, India 31%, Japan 15%, Singapore 13%, China 4%, and the remaining 2% came from North America. Exports for the quarter was around 69% of our revenue, and I believe export will continue to be a major contributor to our top line going forward. Our top 10 customers contributed 83% of the total revenue, and there is total of 24 products that we provide to them. With that being said, we will open the floor for Q&A. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may enter star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of S. Ramesh from Nirmal Bang Equities. Please go ahead.
Hello, good evening, and thank you very much. I wish you all very happy Diwali and the best of season. So, and to start with, you mentioned the accelerated capex and formulation and products, and the capex of something of the order of 600 crores. So, can we get a sense in terms of what is the proportional capex that is going to the formulation projects, and what will be the increase in the share of formulation products compared to your current percentage share out of your overall revenue once the formulation products are commissioned?
Okay. I'll take the question. Hello?
Vishal, shall I answer this?
Yes, please. Yes, please, Ananda, please.
Yeah, so thank you, sir, for your question. So basically, all of these plants are going to be multi-purpose plants, and in which fluorination will be one of the chemistries that will be taken into the product. Yes, there will be a leaning more on the fluorination side, and that is where we have seen a lot of activity from our customer side. And again, some new interesting products which we have mentioned earlier, which we are going to launch in the coming years, will be manufactured in these new multi-purpose plants.
Okay, so in terms of the commercial impact of your capex, when do you see the full impact of the capex to be funded by the QIP? And what is the reason for the additional capex? Because of the QIP offer document, you mentioned a capex of 419 crores. So added another 193 crores. So is it possible to give us the split of the total capex, including the device number, and when do you see the full impact of the entire capex program?
Vishal, you can add on the full impact on the timeline, but on the products, Mr. Ramesh, what we are seeing is that there is a huge demand from customers coming in for new products that we have been planning for the last 2 years. And based on those demands, that is why we have expanded the capex currently, and that is why we have gone forward for the QIP. I think there will be some forward-leaning questions, answers, so I will not let you go into that right now. But maybe once the statements are clear, we will be able to give you more information going forward. So we hope that you can add on the timeline for the project completion.
Sure. So, Mr. Ramesh, if you see when we said 670 in the opening remarks also, that is 250 crores that we had earlier announced, then 220 plus 190 crores. These are the total 3 projects that we are undertaking. And this we are planning to complete in next 24 months, 18 to 24 months, as Amit Bhai had also mentioned in his opening remarks. And within another 1.5 to 2.5 years from then on is where we are expecting it to reach the fairly full capacity of the plants by then. So that's the kind of timelines that I would suggest.
So just to get some clarity on the LOIs and contracts you have and the capex which was planned earlier of 250 crores. So this additional capex and the overall number of about 670 crores. Is there any additional capacity you're creating for expanding your order book? Can we get some light on that?
Can you explain it? Can you just repeat again and explain what we are trying to ask here?
Yeah. So basically, you had mentioned that this 250 crores initial capex you had indicated last time was for the LOIs and contracts worth 2,620 crores. So in addition to this, you are spending another 420 crores. So is there an overlap of capital expenditure required for this LOIs and contracts already announced in this 420 crores of additional capex? Or are you planning additional capacity and business capabilities to building your future growth in terms of new contracts and new LOIs you may add in future?
Yes. So, Mr. Ramesh, as we mentioned that, yes, 250 crores is what we have expend for the LOIs and contracts, and others are for the capacities that we are creating, as Anand Bhai had mentioned, for the new products and the additional demand that we have been seeing from our customers, both on the fluorination and other parts of the business, and that's what the balanced capital deployment will go for.
Okay, thank you very much, and all the best. I'll join with you.
Thank you.
Thank you. A reminder to our participants, if you wish to ask a question, you may enter star and 1. We'll take our next question. That's from the line of Vidisha from IIFL Securities. Please go ahead.
Hi, good evening, and thanks for taking my question. So just to take this point forward in terms of this additional capex that you've announced of roughly 430 crores, is this to do with this expansion and fluorination of that you mentioned on slide 15 with a revenue potential of 220 to 260 million? Is this capex going to be largely for these 6 to 7 products that molecules that you mentioned out here?
Anand, should I take?
No, you go ahead. Sorry.
Okay. So, yes, this will also cater to the 14 new products that we had mentioned in the slide as well on the fluorination, and we will have some more capacity to do other products as well. But largely, yes, it will also cater to the fluorination part of the business, which is what we have presented as slide 15. We have mentioned that there will be 14 new molecules that we have identified.
Sure. So, I mean, so just to understand the capex needs of these of this revenue potential, I mean, is it safe to assume a 1.75 asset turn for this 220 to 260 potential? I mean, I'm just trying to figure out how much capex would be totally needed to sort of reach this revenue potential that you mentioned on slide 15. Like with a 1.75 asset turn, it comes with roughly 1,000 crores of capex. So that would be another 600 crores to get to full potential. Would that be a fair understanding?
So this 220 to 260, what has been mentioned, is the full potential going forward over a longer period of time. When we say 14 molecules, we are talking about a subset of this number. And hence, what we guided, what we are mentioning is 1.75 is the minimum that we would expect from the capital deployment, which will be catering through these 14 molecules. But we plan that we may be able to do a better asset turn than that as well. But for now, we are only mentioning 1.75 as the multiple. But these are two different. So basically, you may want to read the 220 to 260 as a different number. Then the total 220 to 260 is a total that is around more than 30 molecules that we will be commercializing over a longer period of time. And that's what is mentioned here.
Okay, got that. And in terms of margins of these molecules, will they be similar at to the current margins that the company operates at?
They should be better, but let's look at similar margins for now, and then we can see as we go.
Okay, understood. Secondly, my question was around these two new LOIs in the benefits of the Europe Plus One that Anand mentioned in the opening remarks. So if I look at slide 14, the number of LOIs and the revenue potential has sort of remained the same. So how much revenue would these LOIs bring in addition to these 5, 6 LOIs that we've already signed? Would this 2,600 crore number change materially because of these two LOIs that have come?
So first is that the 2,600 is a number which was for the quarter ended, and the LOIs were signed after that, and that's the reason the number has not been added onto it. However, that number should be around $10 odd million in terms of this. So yes, in that context, it will be a limited impact on the LOIs and contract if you were to see the total size.
Okay, so it's $10 million, is it?
Yes, that's what.
Okay, understood. And just one clarification on just the change in accounting, that you've done. I missed the revenue number, the consolidated revenue number that you mentioned, but you happen to say that Tanpac has not been included in the consol revenue. But in the results, your 1Q revenue seems to suggest that Tanpac has been consolidated with a minority interest being recorded. Could you just explain the accounting that you've done?
Sure.
And how it's going to be going forward?
Sure. So basically what we were saying was that for FY23, post May 21, the consolidation is on a full basis. However, for FY22, the number has not been, the consolidated number is in which it has not been added because that time we had not done an acquisition, and hence when you're looking at the comparison, we want you to be aware that for FY22 there is no consolidation of Tanpac numbers, whereas in FY23 post 21st March the number has been added. 21st May, sorry, stand corrected on that. 21st May.
Okay, understood. Fine. Then going forward, it'll be done on a full consolidation basis, 25%.
Yeah, it's a full consolidation basis.
Okay, cool. I'll get back in line for further questions.
Good. Thank you.
Thank you. Our next question is from the line of Rohan Gupta from Nuvama. Please go ahead.
Yeah, hi sir. Good evening and thanks for the opportunity. So though you have given some explanation with regards to new capex, still some doubts and clarifications. So one is that you are planning to spend another close to 500 crore rupees on exclusively on fluorination capex. That is on top of 250 crore for this year and maybe 250 crore for next year. I mean, that was your initial guidance was that 250 crore rupees annual capex. So it means that including this 500, we are planning to spend another 1,000 crore rupees in over next 24 months. First of all, is that understanding correct, sir?
No, when we are saying this number, we are saying 250 for the year. So basically 670 crores is what we are going to do capex from today till next 24 months. That's what we are saying for now. That includes the 250 crores of what guidance will be given for the LOIs and contracts and the other ones. And as second point on this, when we said about the fluorination, it's not only the fluorination, it's other products as well. As Anand mentioned, it will be multi-purpose plants, not only about one product or one chemistry. But yes, there will be a leaning towards catering to those 14 molecules which you have identified. But over and above that, there will be enough capacity there.
And sir, will that 680 crore rupees capex, so you're guiding roughly 1.75x kind of asset turnover, which is significantly higher than the current level of 1.1x asset turn, which we are able to achieve right now. So with the 700 approx capex, you see that how much time, 24 months probably is going to take for commissioning of the capex, and how much time you think that will take further for taking it to almost to achieve that 1.75x asset turn?
2 years from then on, we should be looking at that number. 2.5 years. 2 years plus minus 6 months is what you should look at, where we would be able to ramp it up fully. Because again, why I'm saying this is also because this assets will come on a sequential basis and not on a same day, because all assets will be planned out in that phase as well, right? And that's the reason I'm saying this number in the manner.
Even in a phased manner, all the capex will be commissioned within 24 months, and beyond that, you are saying that it will take another 2 years to achieve a 1.75 kind of asset turn, right?
Correct. And also just wanted to note that the current asset turn is also where we are, where this such capacity should also give us a growth for the next 2 years. So we should be reaching a similar asset turn from these assets as well. So it's not that current assets will only give us 1 to 1.1x it is today, but as we see the next 18 to 24 months, the growth will come from the current capital assets.
Sir, in fluorination, so you have a history of doing this chemistry, but I think that the confidence has increased after the Transact acquisition. So have you got any kind of customer contract or visibility of this capex which you are going to put up 450 crore mainly catering to fluorination? What is the confidence level and how much it is backed by the customer's contract right now?
Anand, would you want to take this?
No, you go ahead, so I'll add later on.
Sure. So if you see here, if you see, there has been when we mentioned also that 14 products. So then we have been in discussion with these customers for a long time. We have been developing these products in our R&D and lab. So it is not that we are starting the process now. That process was done for last 3 to 4 years and more. And today, with the Transact coming in, the supply security coming in, is when the customers are now converting into demand. And that's where we have been able to talk about the ramp up here, because our R&D and pilot samples and all others are being validated, and that's where we are coming from. So the confidence that is there is pretty high from this perspective, because if you understand the product development phase is when there is a product developed, then there is an R&D, then there is a pilot phase, and then you get into commercialization. So here, this 14 molecules, what we have mentioned in slide 15, is where we are practically at the phase of at the twilight of the commercialization phase, and that's where we are coming from, and hence that's the confidence that we are seeing. And in terms of interaction with the customers have been pushing us for many more products. The kind of demand and the kind of confidence and the urgency with which the customers are requesting for the products and the supply is quite unprecedented compared to what we have been seeing in last few years, and what Dr. Kiran and Anand Bhai in his opening remarks also mentioned about the Europe +1 and the interest coming in. We are seeing a very, very strong interest coming from all major customers, current and also few potential ones. Anand, if you want to add something here.
Yeah. So, Mr. Gupta, what I'd like to add on to what Mr. Bhai mentioned there, that the Europe +1 strategy as well as the China +1 is really playing out very hard. The kind of demand and the inquiries for new products, both into fluorination as well as into general chemistry, is unbelievable. For example, the sulfuric acid price in India is one-fourth the price what is in Europe. So you can just imagine the cost. I won't say the arbitrage, that would be too rude, but I think the difference is quite high. So people are desperate in Europe. Of course, they have a long-term view. They have seen this in the past. So they will not take an urgent view, but at least a major movement will start from of products which are not high margin or which are not how you say the security product for them to be shifted out from Europe, and it can be India and it can be China also. But at the same time, what we are seeing as far as Anupam is concerned, a major demand in our existing chemistry, and you will see that most of the products that we are manufacturing go to Europe today. And a major shift is surely happening, and we will be able to give you more information in the coming 3 to 5 months. As I would not like to give any statements now, any forward-looking statements now, but I think in the next 3 to 5 months, you will see a lot of information coming out from Anupam as to what we have been doing in the last 6 to 9 months. And we have been focusing on long-term projects with customers which will be deployed in 25 and 26. But on an urgent note, we are seeing huge demand for a lot of products to be shifted into India from Europe, and that is where we are coming from. Yeah.
Okay, so my side, and that is related to the working capital. So you have mentioned that the working capital days has come down, and with the safety inventory for the customers, that has also been reduced, and in terms of the contract size also, I mean, from the annual to half yearly. By year end, if you can just guide us that what kind of inventory holding period you are targeting, and from the current level, how much we can see the further reduction, and also on the new contract which you are taking, all this in fluorination, the putting new products, and I believe that the most of the customers profile remains same. So for the new product or the new contract, are we still following the same mechanism what we have been following earlier, or it is going to be completely different like for any other agrochemical player where the inventory requirement is not so high? So how is the arrangement on the new products, sir?
Okay, let me address the first question first, and then I'll come to the second one. The first question about looking at the inventory levels, as we mentioned, I think as we had also suggested in the opening year quarter as well, the first quarter this year as well, that we will endeavor to move back towards the historical level of the year before where we were, and we will look at coming to those kind of numbers by the year end, as where our cautionary inventory drops and our business in terms of the contract structure gets amended and implemented. So that's the number we would like to be focusing on, and that will be a fair bit of release from the working capital cycle in that sense. And second, on the newer contracts, you have to appreciate that the way we are designed and structure our business is a more in situ kind of a business where we are more part of our supply chain for our customers, and when we need to, and where we are mostly single or a primary supplier to our customer, there we would need to hold a particular level of inventory. However, if you see the business the risk of inventory is practically not there for us in senses, because the price and volume risk both are passed through, and even the carrying cost for the inventory is also borne by the customer in that sense. So to that extent, we will have a structure similar to what we have in our existing business. However, we will keep on tightening that premise and focusing on a shorter cycle as much as possible. But there need to be a healthy mix of both being a responsible supplier to them and assuring them, especially when we are a single or a primary supplier. So there will be a healthy mix that we will try and focus on.
Fine, yes, sir. Thank you.
Thank you. Any participant who has a question may enter star and 1. The next question is from the line of Rohan Kamath from Fintrust Capital. Please go ahead.
Yeah, thank you for the opportunity. Sir, my first question is basically on the 6 months pricing. I just wanted to check whether it is done for all the customers or not. And just follow up on that, what kind of inventory levels that are accepted for this year and the next year?
Okay, so first is that, as we mentioned, that around 60 to 70% of our revenues, contracted revenues, are now on a 6-monthly basis. And second, as we mentioned and as we guided in the last question itself, that we will endeavor to be moving back to the older inventory cycle levels that we had in the previous year. And going forward, we'll try and focus on compressing that as much as possible. But right now, that's the guidance that we could go with for now.
Okay, sir. The second question is on the CapEx guidance. What kind of CapEx guidance do we have for financial 23 and financial 24?
So again, we say that we are looking at six. So in next this year we should be looking at around 250 crores of capital deployment, and next year should be around 350 to 400 crores of capital deployment. We'll come to that number more clarity between 350 and 400 by the next quarter, that we will be able to give you a bit more clarity on that. But that's the number you should go with for the FY allocation if you were to look at it.
Okay. Thank you, sir.
Thank you.
Thank you. Next question is from the line of S. Ramesh from Nirmal Bang Equities. Please go ahead.
Thank you for the follow-up. So just to understand the consolidation of PanFac, I'm just trying to understand how you have done the broad consolidation and how you are arriving at the minority interest. Because if you look at the PanFac itself and the way you have consolidated, it will be difficult to understand how the numbers are arrived at. So can you explain the consolidation and how you have arrived at the minority interest?
So if you look at the consolidation, we have done a line-by-line consolidation at 100% basis for the opening ones, and that starts from 21st May to 30th September, and that's the number that has been added because on 21st May is where we have deemed to have a control over the company when the open offer was concluded. And then the minority interest comes post the PAT numbers that are mentioned, and that's what is mentioned below, where the minority interest of 74% will be identified.
Now the question is, if you look at the standalone number and consolidated number, the PanFac reported about 8 crores profit. So you are talking about consolidated profit of 478 million or 47.8 crores compared to about 260 million or 36 crores. And the minority interest is not equivalent of that, 75% of PanFac number, which should be closer to adding about 6 crores. So that's where I think the question is.
Yeah. So Mr. Ramesh, the challenge is there is an elimination of 1.6 crores, 1.4 crores of dividend, 1.5 crores of 1.8 crores of dividend and intercompany profits which are there, which has been eliminated. That's the reason it is the number that is not looking right, which is 1.4 of dividend and 0.4 of intercompany profit, which has been knocked off, and that's the reason you are seeing these two different numbers. And so then the minority interest comes below that.
So this 1.8 crores of netting out, whereas it's being adjusted in the consolidated number.
That's what I'm saying. That 8.8 crores was the profit for PanFac, whereas if you see the consolidation is showing only 6 crores of that, and this is because of 2 crores or little less than 1.8 crores of adjustment, which is a knocking off, because 1.4 crores was the dividend which came from PanFac to Anupam, which has to be knocked off, and 2 is 0.4 crores of profit from the business. So that's where the reason. So 8 minus 1.4 minus 0.4 gives you 6.
No,
that's
so
the reason consolidation is a 6.
I'm sorry to belabor the point. You hold about 26% stake in PanFac. So you should be consolidating at the net level. You should be getting only 25% of PanFac's profits, right? So I'm not sure I would understand how you can get 6 crores out of that 8 crores.
So because if you see below that line, there is an adjustment that are shown as a minority interest post PAT, and that's where the numbers are adjusted. Because this is consolidated on a line-by-line basis and not on a 25% shareholding basis. That's the reason these numbers are there. If you go below that on the CFS, you will see there is an allocation for the minority interest as well.
Yeah. So this let me ask it a different way. The minority interest of the 2 crores or 22 million you're showing, does it include any other item? Because technically, it should be equivalent of 75% of PanFac's profit. Because external shareholders own 75%, right? Including 8 crores. So out of that 8 crores, 6 crores should have been set out I'm not able to understand how it's so low at 82 crores.
So if you're talking about September, if you look at it, there is a 6.2 crores of non-controlling interest which is being adjusted on the net profit. If you see below down, there is an explanation given there as well. So 47.3 crores is the comprehensive income, less net profit attributable to owners of the company, 41.5 crores, and non-controlling interest of 6.2 crores has been mentioned in the CFS as we go down post the PAT. There is a line which is going further down up. So if we open the financials that we have submitted to the stock exchange, we will be able to see that numbers, Mr. Ramesh.
Okay, so you're saying, okay, I stand corrected. So this 47.8 crores is before the minority interest for the quarter.
Yes.
Out of it, you are saying 6.2 is the minority. Okay. I stand corrected. My apologies. Thank you very much.
No problems, Mr. Ramesh. This is the first time we are also consolidating, so everyone will take time to get to that. So no problems. Please feel free.
So the next thought is, when you're looking at these 14 new molecules and the increased capex, how are you positioning yourself to source your materials? How much of that is going to be captive? How much you have to import? And what is the arrangement for that? And what is the kind of additional impact it will have on your increase in working capital?
Let me go first and let me answer that for now. Is that, see, our working capital cycle, as we have said, we will keep on driving it as we mentioned in the earlier questions as well. So this increase in business will not expand the working capital, but we'll try and continue to compress as much as possible is the first statement. Second, what we are saying in terms of supply chain, if you see with the acquisition of Tenfac, the import dependence is only looking like reducing. Today also less than 20% of our purchase will be imported, and we will endeavor to keep it as low as possible. We are not seeing any significant change in terms of our purchase profile. In fact, it is only going to go more towards the domestic consumption and more vertical integration for us.
So if I might just ask a follow-up question, in terms of the increase in core working capital, or the kind of capex you're doing, if you get about 1,200 crores of additional revenue, given the kind of working capital number of days, it implies about another 500 crores of additional working capital requirement. So how will you finance that? Will you need further debt raising, or will you be able to fund that through your operating cash flows? What is the company's plans for that?
So, Mr. Ramesh, if you see the kind of operating cash flow that we have generated for the first half, and if you look at going forward, because this ramp up is also looking over next few years, so operating cash flows will be able to suffice any requirement for the growth in terms of working capital. And also there is a bit of a compression, as we had mentioned, that our working capital will compress as we go forward, and that will also ensure that the requirement for the working capital will be to that extent only. So both put together, we don't see any external requirement, any significant external requirement for our growth of our business for now.
Okay, one last thought from me. So between Euro Plus and the China Plus strategy in terms of the customer profile for your current and the new order book you're building, are you going to see your margin profile improve as we move towards more of Euro Plus customers? How will you see that going forward?
So margin profile, I think, we have been always, positioning ourselves with the European customers and European suppliers to that extent in terms of our supply to our customers. So we are typically replacing them most of the time. And there, if you really see the margin profiles, we don't see it to be significantly different. It will be tad better. But right now, as we had mentioned earlier also, we will keep with the guidance of the same margin profile. If we do it better, it's always good for all of us. But right now, let's go with the numbers that we have been guiding for now.
Excuse me, Mr. Ramesh, may we request you to return to the queue, please? There are several participants waiting for the turn.
Yeah, thank you very much. Appreciate it.
Thank you. Our next question comes from the line of Dhruv Muchal from HDFC Mutual Fund. Please go ahead.
Yeah, thank you so much. You mentioned about increasing opportunities from Europe and customers looking more for us. So if you can speak a bit more about these opportunities, are they short-term, are they long-term, based on the nature of inquiries that you're getting, also the kind of sectors that exposure that these inquiries are coming from, and also you mentioned that there is the intensity is very high now. So does it mean that in future there is a scope that the ROCs that we probably used to demand earlier can improve significantly going forward, or do you think there is enough competition in the market for these kind of sourcing opportunities that the ROCs will remain at the levels that we have been doing, I mean these 20%, or do you think given the supply demand dynamics the ROCs can be in future can be even better given your demanding position now?
Anupam, would you want to take the question?
Or do you do the second part?
Sure.
Dhruv, I think in Anupam's case, we tend to prefer to take long-term contract-based products only. And that has been the modus operandi of the company going in the last so many years. I mean, you will see so many products which have been, having a long-term perspective. Even there are some products which are not in contract, but which we've been manufacturing since 2004, and still today they are without a contract, but issued to Anupam only, and even in some cases they are on an exclusive basis. So this model we would not want to change. We only look at a long-term agreement kind of products only, even if there is not a written agreement, but there has to be a understanding between us and the customer, and based on our relationship of last so many years with all the major majors, I think it's very clear. And in the future, if Europe situation changes, once a product comes out, there are so many things which are associated with it: registrations, internationally, locally, domestically. A lot of things have to be taken into accordance over there. And so when a customer gives a product to, or rather plans to take a product out from a certain manufacturer or a country, there are a lot of issues involved. It's not a knee-jerk reaction that today the prices are high in Europe and so we'll take it to India or China. It's not that. I mean, there's a lot of thinking going into that. Yes, Europe plus one situation is giving an impetus to that. Some products which we are planning in 25 will be launched in 23 itself. So yes, some products will be fast forwarded. But again, coming back to your main point, Anupam prefers to take products which are having a long-term agreement or a off-take agreement only. That is the plan, and that is how we go forward. And customers like us. I mean, like that, they understand Anupam's philosophy of a cost plus, the cost plus basis agreement. I mean, a price transfer. So they are also aware about it. And of all the costs that would be incurred onto that product to be manufactured. So I think we are very clear on that part. We tend to be a good supplier in that sense that we optimize the process, we share the benefits with the customer and ensure that his interests are arranged over a long-term period. So that would be my answer to your first question. On the second part, on the ROC part, I'll ask Vishal to take it.
Yeah. Thank you, Anand. See, on the ROC side, as we said, yes, when you have a higher demand, you tend to have a better bargaining power. However, the way we see things is that we look at sustainability, visibility, and profitability. And all three are completely important, and we would want to have a long-term sustainable business with them. So we will be looking at a good ROC. However, it has to be also making sense for a customer, and it should be sustainable that they don't look for other suppliers going forward. So the range that we have been suggesting, which is 20+% ROC, should be there. Now, how many percentage points we can always discuss as we go, but primarily that's where we will be looking at.
Sure. So basically, you continue to target this 20% plus ROC. At least yes. that ROC.
Yeah, absolutely. And customers are more than happy to offer that. Appreciate it.
Dhruv, what to add over here? See, I mean, Anupam has been known to be a fair supplier. I mean, we do not take advantage of any manufacturer issues in Europe or anywhere else. We have always tried to see our benefit, the customer's benefit, not our benefit, because that is what pays off in the longer term. and that is the hallmark of where Anupam stands. I mean, all customers appreciate and understand. We know for a fact that most of the products that we offer are manufactured in Europe. And in the last 12 months, a lot of things have happened in Europe, but we have never taken an advantage of what's happening over there. We see our benefit, we see our understanding of the business, and we ensure that come out looking as a logical supplier, a rational supplier, and not take advantage. I mean, people do take advantage of customers in this situation, which we prefer not to, and customers appreciate that. Customers are 11, they are elephants. They remember for a long time, and we prefer to be a rational supplier and not take advantage of any. I mean, not only a customer, even a supplier, even our supplier for that matter. We are known to be a fair company and a logical company, I would say. Yeah.
Sure. Clear, sir. Thank you so much and all the best. Thanks.
Thank you. Ladies and gentlemen, that was the last question. I now hand the floor back to the management for closing comments. Over to you, sir.
Thank you everyone for your questions, and we hope we have been able to answer most of your queries. If you have missed out on any of your questions, kindly reach out to our IR advisors, EY, and we'll get back to you offline. Hope you have a good weekend. Look forward to your continued support in our growth journey. Thank you. Happy Diwali once again to every one of you.
Thank you, members of the management. Ladies and gentlemen, on behalf of Anupam Rasayan India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect.